Hello, I'm Michael Cochran with BentOak Capital, here to provide a special market update. This month, we will look at recent market and economic events and a few additional action items clients can do during times like these. Please remember to stay tuned at the end of this video for a required disclosure statement. In the middle of the month, we officially entered a bear market, thanks to persistently high inflation that we have seen for over a year now. While we recently crossed the threshold for a bear market, it has probably felt like a bear market for a while now, as most asset classes have been negatively impacted year to date. The more well-publicized Consumer Price Index inflation reading that came in earlier this month spurred the Fed to take a more aggressive stance and raise rates more than many had expected just a few weeks prior. For those worried the Fed may be overly aggressive in its fight against inflation, consider the market has done a lot of work already. Home price appreciation has slowed on higher mortgage rates. Lower stock values will likely slow spending, and news on wage increases has leveled off. Financial conditions are already tightening early in the Fed's campaign. This is actually good news since the Fed will continue to monitor many factors as we progress through the summer, and they will reevaluate additional hikes as we move through the second half of this year. In a recent blog post, we highlighted 3 action items clients can take in volatile times like these. The first is to reframe the current market versus the long term. We are hardwired to think that whatever has recently happened will continue for an indefinite amount of time, which we call recency bias. But history tells us that isn't how the market actually works. During another choppy period like this, a colleague made a point that has stuck with me for years through a simple question. Name one time the market didn't recover. We're in a difficult period, but perspective does help. Over the past 100 years, the market has annualized about 10% per year and is positive 7 out of every 10 years. Add that to earnings that steadily grow over time, and we have a very different perspective compared to what is currently happening. The second action item is to rebalance your portfolio. Rebalancing your portfolio is a practical and prudent thing to do in this type of environment. Perhaps there is an area of your portfolio that has been over-concentrated. It's important to realize that rebalancing is typically just a tweak or small adjustment. We are not suggesting that you make wholesale changes to your portfolio strategy in the midst of the storm, but small incremental changes at market extremes can be beneficial over the long run. The last action item is to revisit your financial plan. A financial plan is not about controlling what is going to happen. It's about deciding in advance how you will react or not to things that are out of your control. It goes without question that no one will reach their financial goals consistently if they are prone to panic and bailing on markets during uncertainty. Without revisiting and adhering to a plan that addresses the core objective of your assets, it's hard to move forward with confidence. While it's challenging to stick to the game plan, it is important to zoom out and focus on the long term. That being said, if you'd like to revisit your financial plan or know someone that might benefit from planning, please don't hesitate to contact your advisor. That wraps up this month's video, but if you're interested, be on the lookout for additional resources, including webinars, blog posts, and future videos. We are committed to being here for our clients in all market environments. And if you have any questions, please give us a call. Thanks.